Dr. Marcus Webb was a 44-year-old orthopedic surgeon in Columbus, Ohio. His hands were his career. In 2021, a car accident damaged the tendons in his right hand. He never operated again. He had disability insurance, 11 years of premiums. When he filed his claim, benefits started, then stopped 8 months later. The reason was on page 34 of his policy, a clause his broker never mentioned, a definition most physicians don't know exists until it's too late. Today we're going to talk about that clause and the 3 other gaps that make most physician disability policies far less protective than you think. Disability insurance is the product physicians are most likely to own and least likely to understand. The pitch is simple. If you can't work, you get paid. Sounds straightforward. It isn't. The people selling these policies are not required to explain every clause. They're required to sell. And the average physician buys disability insurance once, in their first or second year as an attending. They're busy. They trust the broker. They sign. They don't look at that document again for a decade. That's exactly the window the insurance industry is designed to operate in. There are 4 specific areas where physician disability policies routinely fail. We're going through each one. The first, and most critical, is the definition of disability itself. 2 definitions exist. The first, own occupation. You are disabled if you cannot perform the specific duties of your specific specialty. A surgeon who can no longer operate is disabled, even if they could technically consult or teach. The second, any occupation. You are only disabled if you cannot work in any job suited to your education and experience. A surgeon who can no longer operate but could teach medical students is not disabled. The difference is enormous, and many physicians own any occupation policies, or worse, policies that start as own occupation and convert to any occupation after 24 months. That conversion clause is exactly what stopped Dr. Webb's benefits. For 24 months, he was covered as a surgeon. Then the policy asked, can he do any job? He could consult. Benefits stopped. The second gap, elimination period. Most policies have a 90-day window before benefits begin. Some have 180 days. Do you have 6 months of expenses liquid right now? Your mortgage doesn't pause. Your car payments don't pause. Nothing pauses. The third gap, income definition. Benefits are calculated on your income at the time the policy was purchased, not today. A physician who bought coverage in residency and never updated it will receive benefits based on a $65,000 salary, not their current $380,000. The fourth gap, specialty specificity. A policy covering you as a physician, not as a neurosurgeon or interventional cardiologist, allows the insurer to argue you can perform general medicine even if you're a subspecialist. Your specialty must be named explicitly in the policy. 2 physicians, both interventional cardiologists, both earning $520,000. Physician A, group policy through her hospital, $180 a month. Any occupation after 24 months, 180-day elimination period. Physician B, individual policy through an independent broker, $380 a month. True own occupation, specialty specific. 90-day elimination period. At 51, both develop essential tremor. Neither can perform catheterizations again. Physician A collects for 24 months. Then, policy converts. Insurer determines she can perform outpatient general cardiology. Benefits stop. She spends 2 years fighting the denial. Legal fees, $80,000. Partial settlement. Physician B files a claim. Policy says, cannot perform interventional cardiology. Disabled. Benefits start at 90 days. $26,000 a month to age 65. Total benefit value, $3.6 million. Same diagnosis, same income, same coverage percentage. $3.6 million difference because of two words, own occupation versus any occupation. One more issue nobody talks about, portability. If you leave your employer, your group coverage ends. A physician who develops any condition while employed, high blood pressure, a back injury, a mental health diagnosis, may find that condition excluded from any new individual policy. The time to buy individual own occupation coverage is when you are young and healthy, not when you need it. Here is exactly what to do. Step 1. Pull out your policy. Find three things. First, the definition of disability. If you see any occupation or own occupation converting after any period of time, that is a gap. Second, the elimination period. If it's longer than 90 days, you need liquid reserves to cover that window. Third, how income is defined. If it references your income at policy issue, you are likely underinsured. Step 2. Check specialty language. Does your policy name your specific specialty? If it says physician or medical doctor without naming your field, call your broker and ask for a specialty-specific rider. Step 3. If you have only a group policy through your employer, price an individual own occupation policy now, while you are healthy and insurable. The group plan is a floor, not a ceiling. Step 4. Do not buy or update disability coverage from the same person who sold you whole life insurance. Find an independent broker who specializes in physician disability. They exist. They charge the same premium. The difference is what they explain before you sign. Dr. Webb's case didn't end in bankruptcy, but it ended in a settlement worth a fraction of what his policy should have paid. 11 years of premiums. One clause he never read. You now know that clause exists. Next video, the whole life insurance policy that was sold to you in your first year of attending life, and exactly how much it's costing you. Subscribe. Every video on this channel is a gap your financial advisor, your broker, or your employer never closed. I'll see you in the next one.